This is Real Estate This Week with Stephen Gasque, continuing 16 years on air and online, helping you succeed in buying, selling, and investing in property. The best real estate strategies out there just for you.
Welcome to Real Estate This Week. Hi again, I'm Stephen Gasque, and I'm so glad you're here as we talk about how to nail it, no matter what kind of real estate you want to do. Just you, me, and the best real estate guests in the country. Today, how to get the best mortgage. Not only the mortgage with the best rate and the best terms, but the absolutely, positively cheapest mortgage you can get. Easy to afford and easy to pay every month. How's that sound? So let's talk to an expert about how to make that happen. Joining us now is Keith Gumbinger, Vice President at HSH.com, the nation's leading source for consumer mortgage and finance information. Keith, welcome to Real Estate This Week.
It's good to be here, Stephen.
I am so glad you're with us. And so, Keith, I'd like to talk to you today about getting the best mortgage out there with a special emphasis on the lowest rate, the smallest monthly payment, and the easiest mortgage to pay for, the cheapest one possible. How's that?
Sounds good.
Here we go. Now, you've told us before that having the best possible credit will have a huge impact on the size of your monthly payment and the rate you pay. So tell us, how good does your credit have to be to get the best mortgage out there?
Well, the higher credit score you can have, the better, Stephen. The lowest cost mortgages are available to those with FICO scores of 780 and above. And the closer you can get to that mark, the better your interest rate is going to be.
I see. And Keith, if my credit is not 780 and above, like normal human beings, how much of a hit will I take on the mortgage interest rate if it's lower?
Well, as you slide down the credit scale, your costs are going to increase. Now, each credit bucket is about 20 points. So if your credit is middle of the road, say between 720 and FICO 739, you'll see an interest rate that's about a quarter percentage point higher than someone with the same down payment, same loan fees, and a top shelf FICO score.
And so, Keith, if you need to get your credit score higher, there's really just two things to do. One, you check your credit report for mistakes, and if there are any, get on them. The other is look at how much debt you're carrying and try to reduce that, because the lower your debt, the higher your credit score. But Keith, that's all going to take a lot of time.
Well, the most important thing you can do is actually pay your bills on time if you want to keep your credit score elevated and even rising. Now, if you want to buy a home, you can't start improving your credit too soon. Fannie Mae and Freddie Mac are now using so-called trended credit reports, looking at how you managed your money over as long as a 2-year period, rather than the 6 months that used to be common. As such, it can take longer to get your credit in tip-top shape. So if you're thinking about buying a home sometime soon, get started fixing that credit.
Absolutely, because wow, if you can get your credit up there, you will have a big improvement in the size of your monthly payment. Now, Keith, what about the amount of money you need for the down payment? I mean, if you have the ability to put down 20%, will you get a better mortgage interest rate than if you could only put down, say, 3%?
Well, the answer is that you'll generally get a better interest rate with a larger down payment, but not necessarily always. A couple of years ago, in the name of improving affordability, Fannie Mae and Freddie Mac rejiggered their add-on fees for lower credit scores and smaller down payments, helping to lower these loan-level price adjustments for borrowers with lower down payment and credit scores.
Interesting. And Keith, of course, one of the best parts of being able to put down 20% on your house is, in most cases, you can then avoid private mortgage insurance, called PMI. Because if you have to pay PMI, that could be hundreds of dollars every single month.
Well, that's true. The smaller your down payment and the lower your credit score, the higher your PMI payment is going to be. Now, PMI is a policy you pay for to help protect the lender in the event that you should default. Now, in the simplest way of thinking, a borrower with a small down payment is thought to have less reason to keep up payments if things go sour. And if the home goes into foreclosure, PMI ensures that the lender will have funds available to cover the cost of acquiring, cleaning up, and remarketing the property. I mean, believe it or not, there's a lot to know about PMI, which is why we have a comprehensive guide at hsh.com to cover it all.
Oh, that's really good to know, Keith. And you know, another strategy you've discussed with me before about getting the best and most affordable mortgage out there is simple. It's just to shop around. Don't talk to just one lender. Talk to 2, 3, or even 4 lenders and see if you can get the best possible rate among all of them.
Well, if you've ever bought a car or other high-ticket item, it's very unlikely you only went to one dealer before you purchased it. So why wouldn't you do the same for what's likely to be your life's largest debt? You might think that interest rates and fees are the same everywhere, but you would be wrong. There can be a wide range of deals in a given marketplace, and lenders engage borrowers in different ways. Some use price, some use service, some use convenience. Now, not all lenders offer all products, and lenders may compete more strongly on price for some products and not others. You have to shop your market and beyond it if you want to find your best deal.
Shop around. Great advice, Keith. Now, also, some people might be wondering if you do shop around and talk to a bunch of different lenders, they might be afraid their credit score will come down because every one of those lenders will pull their credit. Is that something to be concerned about?
Well, generally, talking to lenders won't affect your credit score, even if they are pulling your credit score to take a look at the kind of borrower that you are. Credit inquiries for the same type of credit over a short time window, such as 30 days, where you might be shopping for a mortgage, should have no effect on your credit score. I mean, all those inquiries are generally treated as a single instance.
Excellent. And so, Keith, now, assuming that you do have decent credit and you have enough money saved up to do the deal and you've shopped around for a lender, what else can someone do to get the absolute smallest monthly mortgage payment possible?
Well, if you've got some extra cash, you might consider paying a point or two to lower the loan's interest rate. Each point is 1% of the loan amount, and the first point you pay can lower the interest rate by as much as a quarter of a percentage point. As well, while there may not be much of an effect on your interest rate, a larger down payment always means a smaller loan amount, and borrowing less money will also lower your monthly payment.
Excellent. And Keith, we should also tell people that if they go to apply for a mortgage, chances are they're going to be applying for the 30-year fixed rate conventional mortgage. And that's a good thing because in most cases, that is the most affordable mortgage you can get.
Well, I mean, a long-term fixed-rate mortgage offers a predictable monthly payment, and stretching payments over a long time horizon can make it easier to carry a large amount of debt. If we go way back in time, back in the 1960s and earlier, 20-year terms were most common. But as home prices and interest rates moved up over time, longer terms allowed buyers to keep participating in the market despite higher costs.
And so, Keith, we've talked about the 30-year fixed-rate conventional mortgage. Let's also talk about another really popular mortgage, the FHA. Tell us, Keith, what is that, and how is it different from other mortgages?
Well, Federal Housing Administration-backed mortgages are different in a few ways, Stephen. The FHA has typically aimed at low and moderate income buyers, especially those with small down payments. Generally, they have allowed more liberal qualification criteria, such as higher debt-to-income ratios, and the FHA doesn't use risk-based pricing, so borrowers aren't penalized if their credit isn't great or if they can't make a sizable down payment. I mean, that said, there can be some drawbacks, too. Most commonly, that the mortgage insurance borrowers are required to pay usually can't be canceled.
I see. And another possible drawback, Keith, is that some sellers don't like an FHA mortgage because the FHA will inspect the property in ways that wouldn't happen with a conventional loan.
There's definitely more hoops for the seller to jump through in the case where a buyer is coming in using an FHA mortgage. So, yeah, sellers don't particularly care for them much, but they can be really helpful for buyers.
Absolutely. And now, Keith, let's talk about some other mortgage alternatives, things people might not know about, beginning with ARMs, adjustable rate mortgages. Tell us about those, Keith.
Well, ARMs have been around since the early 1980s, and their premise is pretty simple. While payments are usually based on a 30-year term, the interest rate on the loan is only fixed for a period of time, ranging from 1 to 10 years. After that, it'll float based upon where interest rates are in the market, changing every 6 months or even a year. Because these allow a lender to have their investment in your loan keep up with changes in interest rates, the lender will usually offer you a lower interest rate for the fixed rate period. So you get a lower payment for a time, and they get a loan that reprices at some point. I mean, there's a lot to know about ARMs, of course, and we do have a comprehensive guide at HSH for those as well.
Excellent. And also, Keith, we understand there are customizable mortgages out there, in which, for instance, if you know you're going to be retiring in, say, 12 years, you can get a 12-year mortgage so that the day you walk off the job, that mortgage is paid. Keith, tell us about those.
Well, some lenders allow you to choose your term at the outset of the loan. It's an opportunity to better time the ending of your loan with other financial or life events, such as retirement. I mean, while this can be valuable, especially those refinancing who don't want to re-extend the term of their loan to a new 30 years, it's important to remember a few things, including that the shorter term you choose should also bring a lower interest rate than a comparable 30-year loan. If it doesn't, you might actually be better off with a loan term that does provide a break, and then prepay it to get the actual term you finally want.
I see. Great idea, Keith. Great idea. Now, let me ask you about something we hear a lot in today's market, which is if someone wants to buy a house, don't wait for mortgage interest rates to drop. Instead, go out there, get that house, and then in the future, if mortgage interest rates do drop, then refinance. Now, tell us about that strategy, Keith. Is it a good one or not?
Well, it can be, Stephen. I mean, there are no guarantees that interest rates will be lower in the future or lower enough to make a refinance valuable to you. But if you don't jump in, even if the timing isn't optimal, you may miss the chance of getting a great place to live. Now, refinancing your mortgage down the road will usually be much easier than when you're buying a home. I mean, after all, you're only dealing with the mortgage, not the whole real estate transaction. So if market conditions or a given new loan deal doesn't work out at some point in the future, well, all you're stuck with is what you already have, your home, but no benefit or no loss, just the same mortgage.
I see. And Keith, as some of my real estate friends tell me, in their view, it's better to buy real estate and wait than it is to wait to buy real estate.
That's a pretty good strategy to think about, Stephen, since future costs aren't known, and home prices tend to rise over time. So if you've got a chance to get in, it's usually a good idea.
Absolutely. So Keith, let's recap. Tell us the top 3 strategies you would use yourself to get the absolute least expensive mortgage available if you were buying a house this year.
Well, it's important to decide what you want beforehand. A 30-year fixed rate mortgage is great, but it isn't always the best choice for all situations. You might be able to save some money choosing an ARM with a fixed rate period that meets your needs. So try to decide where your future is going to go before you select the mortgage product that's right for you. Now, once you've decided, shop hard for it. That includes searching your local marketplace and on the internet. I mean, a great place to start that sort of search is at HSH, where you can learn about mortgages, options, and strategies to get the best possible deals and run calculators and that sort of thing. And of course, if I had a third one to throw in there, it's consider how to best allocate your cash. Put more money down or pay points to lower the interest rate. Both have benefits over different time frames, and it may make sense to do one, the other, or neither. So sit down with a pencil and a piece of paper and figure out what's the best allocation of the dollars you have available to make that transaction work.
Excellent. And Keith, I really want to thank you for being on the show this week and telling us all about mortgage strategies, how to get the best mortgage for you and the most affordable mortgage for you. Thank you, Keith.
Always my pleasure, Stephen.
Ours too. Keith Gumbinger, Vice President at HSH.com, the nation's leading source for consumer mortgage and finance information.
You're listening to Real Estate This Week with Stephen Gasque.
And now it's time for Beyond the Basics, a special segment on Real Estate This Week in which we bring your real estate knowledge to the next level. A few minutes ago, we talked about some of the best strategies for saving money when you get a mortgage. And one of them is shopping around, going to several different lenders instead of just one. So now, let's dive a little deeper into that strategy and look at where to shop around. Now, sure, an excellent starting point is your bank, the one you already use. Give them a shot, because if you've been a customer for a few years, that loyalty could possibly pay off. Some banks offer existing customers a discount on home loans, but some don't. Even so, it's good to find out. And the fact that you're already a customer might make it an excellent place to start. Next, definitely look online. You've probably heard that some of the biggest mortgage lenders in America have no physical offices at all because they're entirely online. Give them a try too and see what kind of rates and what kind of terms they will offer for you. And also, talk to a local credit union, either one that you already belong to or one that will allow you to join. Most credit unions have one big advantage over national banks and online lenders, and that is they're usually located right there in your community. So, when you tell a lender that you're interested in a house just a few blocks off Main Street, chances are they'll know exactly what you're talking about. And that local touch means a lot. Credit unions are investing in their communities, and that might mean good news for your mortgage. And now, once you've talked to 3 or 4 lenders, don't be shy about playing them against each other. If one offers a better rate, ask the others if they can match it. Some banks will compete that way and offer to match or beat the competition. But other banks won't, because they don't compete at all. But you should give it a shot, because remember, if you can get your rate down even a quarter point, that will save you a ton of money. Now remember, when I talk about shopping around for a mortgage, I'm recommending you try different types of lenders. I'm not saying any certain one is the best for you. Only you can find that out. But by shopping around, you're taking a huge step towards getting the best and the most affordable mortgage for you. Coming up next on Real Estate This Week, did you know that you might be able to get thousands of dollars, maybe tens of thousands of dollars to help you buy a house using down payment assistance? Well, it's true. Down payment assistance is next on Real Estate This Week. And until then, I'm Stephen Gasque, and thank you for listening.
A brand new episode of Real Estate This Week with Stephen Gasque drops every Thursday, everywhere. And you're invited to listen, subscribe, and follow us. Just look for Real Estate This Week with Stephen Gasque. The best real estate strategies out there, just for you.